What the hell is going on, guys? I want to talk to you guys today about something that you guys might be thinking about or you want to get involved with in the future. I'm going to be comparing Roth IRAs versus traditional IRAs. Now, uh, I'm probably not going to show you guys anything that you can't look up online by yourself, but I think what I might do is give an example for you guys that I worked out that might be able to help you guys understand more about what we're talking about when you just look through the actual, I guess, text of what it's trying to explain. So I personally utilize Fidelity, and so they give you a lot of great content behind, comparing different items. So if you want to catch more information or study up on this after the video, feel free to stop by Fidelity's channel, or not Fidelity's channel, but Fidelity's website. So first and foremost, comparing Roth IRA versus a traditional IRA, both you can invest up to $5,500 a year unless you get to 50 years old, which then you can do $6,500 a year. A year is up to April of whatever year that you're into, so whatever the tax day is for whatever year you're in. So technically for a Roth IRA, you can contribute April 17th of 2017, you can have contributed all your $5,500 for the 2016 tax year on the 17th of April. So that's something you should keep in mind. One thing that you should also look out for, though, is if you over-contribute or you hit an income limit, that has to be done and taken care of before the new year starts. So let's say you accidentally put in $6,000 somehow, or you made more than $120,000 and you put in the $5,500 IRA limit. You have to take care of that before December 31st of 2017 or the business day before that. Otherwise, you'll get penalized and have to do some fancy tax stuff. I don't even know necessarily what it is, but it's just going to be a headache, so I would just avoid it altogether. And then it talks about there's no minimums, whatever. It's not really important. But then let's really look into what the differences are, right? So you have tax-free growth and tax-free qualified withdrawals with the Roth IRA. I personally utilize the Roth IRA because I'd rather pay my taxes now, and when I get to time where I actually start needing those at 59 and a half or whatnot, I don't have to pay any taxes associated with that, and I think that's very more about how I live my lifestyle, and I could get a couple $100 more now, a year if I were to do a traditional IRA and write it off on my taxes, but I'd rather pay my taxes now than worry about it later. Whereas a traditional IRA, you can actually utilize this to deduct your income for the year, which I'll show you guys in my example, and therefore you get a tax refund at the end of the year associated with being able to write off some of these, some of the value that you put into your IRA. Roth IRA, you can contribute at any time and also take it with you for, pass it down generation after generation. A traditional IRA, you can contribute only up until 70 and a half, and that's basically it. You can't contribute any more after that. With respect to income requirements, with a Roth IRA, since there is tax-free growth advantage and you don't ever have to pay taxes on it at all, there is income limits, and they might be high for some of you. Some of you might be like, oh, damn, I'm already past that. There is ways around it. I can cover that in a different video. It kind of gets a little bit complicated if you don't necessarily know what you're doing. But yeah, so for the 2016 year, if you're making 117,000 or below, you're good. You don't have to worry about phasing out any of your contributions. Phasing out just means you have to go and realize what percentage you are between these two, and you might have to subtract away how much you can contribute up to that 5,500. And then of course, if you're filing jointly with a spouse, your income limit's a little bit different. So just utilize that to bounce things off of in the future. Whereas a traditional IRA, since you are essentially going to be paying taxes no matter what when you retire as income, you don't necessarily have to worry about what your income is now, because you'll still pay taxes regardless, right? So that brings me into the next point. So when you withdraw, A Roth IRA, you don't pay any taxes, right? So you don't get to write off any taxes in the beginning with a Roth IRA, and therefore you don't have to, and you're contributing after tax money into your Roth IRA, so therefore you don't have to pay any taxes when you withdraw, right? Makes a lot of sense, right? And also you can actually take out your contributions as long as they're past the 5-year aging. They've been in there for a while, and you meet, some of the requirements, which is, death, or you're going to use it for housing, going back to school, any of those items. Whereas a traditional IRA, and I think a lot of people don't realize this, no matter what, once you start withdrawing from your traditional IRA, every dollar that you take out is going to be taxed at whatever income limit you take out. So let's say you end up taking out at $50,000 a year. It's not just what you contributed versus what your gains were or anything like that. It's like, no, if you take out $50,000 that year, it's going to be taxed like as if you're working a job at $50,000 a year. It's not going to be, you know, capital gains taxed or anything like that. It's taxed as regular income, and I think a lot of people don't realize that. And I think that's why people are like, oh, well, let's take my money now, and they will take the tax deferred and the write off this year, as opposed to later on down the road. Um, of course, with either of these, you have an early withdrawal penalty if you take out. I think both of them, if you take out before 59 and a half, you have to pay the 10%. But if you do that with traditional, you'll have to pay all the taxes associated with it, right? Like I mentioned a little bit earlier, with a Roth IRA, you don't have to take out any distributions throughout your entire lifetime. You can transfer it down through different generations if you want to, leave it off to your heirs. Whereas with a individual retirement account, um, or a traditional individual retirement account, I'm sorry, you will have to start taking distributions at 70 and a half. So that means no matter what, you'll have to start taking it at whatever it is per year, for whatever the required minimum distribution is. I'm not entirely too sure about that item, so maybe I'll look it up and get back to you guys on that. So yeah, I mean, you can kind of compare and contrast whatever you want, utilizing different websites. Fidelity has this information. You can go to another one; it might be more specific. But I mean, what does this all mean, right? So I want to factor this in as something that someone can really relate to, right? So maybe we can zoom in a little bit on this so you guys can see a little bit better. So let's just say, for simplicity's sake, you make $100,000 a year, right? And so that puts you in the 28% tax bracket. So if you guys notice, if you don't know what your tax bracket is, you could always go to NerdWallet or go to the government website to figure that out. But basically, if you're making $100,000, you basically just go to your taxable income bracket, you look where it is, and basically what it's saying is you tax the 25% up to your $91,900, plus 28% of anything over $91,900, right? So it's a little bit different. So you just take the 932, 526, 18, and then you just basically say, okay, well, whatever, 100,000 minus 91,900, multiply that by 0.28, and then essentially you find out how much taxes are actually due, right? So what does that mean? So if you're contributing to a Roth, right, you're not going to get any benefit or deductions associated with that. So your tax savings is zero, right? So let's say you're 25 years old, you want to put $5,500 into your Roth IRA. You get zero tax savings, and then at a 7% growth rate, your account goes to the $1.2 million, right? That's phenomenal. Hope that it happens for everyone. Remember, does not account for inflation, right? So that's something to keep in mind. Whereas if you were to input into a traditional IRA, you also contribute your $5,500, but at the end of the year, you're able to write those taxes off and get a tax savings at about $1,500, right? So might be good. You could utilize that $1,500 that you get from your tax return and invest it, into an individual brokerage account, or wait for the next year so you can put it into a traditional IRA or a Roth IRA again, whatever you feel like doing. And at the end of the day, your your account is going to grow to the same value, $1.2 million. But what happens when you actually start withdrawing that income? Well, let's say you want to take out money over 20 years, right? Once you get to your, let's say 59 and a half, or let's say in this example, you let it grow for 40 years and you start taking out at 65 years old. Let's say you were 25 when you started, you want to take out at 65, and you think you're going to live to 85. So you start taking out, the what you have in there, the 1.2 million over 20 years, which ends up being just under $60,000. So what happens for your Roth, since you already paid your taxes way up front and you didn't have any deductions, you just get to take home your $58,000, $59,000. But for a traditional, you have to go back to what you think the tax rate will be at that point. So if, let's just say, your taxes don't change whatsoever, and taxes don't go up or down or anything like that, then you could just say, okay, well, worst case scenario, taxes stay the same. When I get taxed, when I withdraw my $59,000 from my traditional IRA, I'll have to pay, $10,000 a year in taxes, and so my take home is really only going to be $48,000. And so that's really why I personally would rather, pay my taxes now. I personally think that, if you end up doing really, really, really well, and let's say this grows to, say, $5 million, let's just say, for instance, it grows to $5 million. Whoops. I mean, you see what I'm saying. I mean, you're going to have to pay, a crap ton in taxes. It's not exact because obviously you're going to be in a higher tax bracket at the end of the day, but you see what I'm saying? I mean, let's just say you have a phenomenal, choices that you make and you end up making, up to $5 million. Let's say you get a 15% return, you get up to this $5 million. I mean, you're going to have to be having to pay 58 or so grand a year in taxes, which you wouldn't have had to do if you just took and ate the $1,400 up front, right? I mean, you get the money from your paycheck as it is, and it doesn't matter. You can just take that $5,500, put it into your Roth IRA, never have to worry about taxes ever again, unless the law changes, of course. Whereas if traditional, if you wanted to do that, that's fine. At the end of the year, you get a tax refund of your $1,400, and then whoop-de-doo, you can, do whatever you want to do with that money. But so for me, I personally think that I'd rather deal with the taxes now. Now it also depends on, what's right for your situation. I mean, I personally think that if you went through this exercise, and I think you should, if you should be, putting into a Roth IRA versus a traditional or what have you. I mean, if you are making only $25,000 a year after tax, or like $35,000 a year before tax, I mean, your situation could be 100% different. I just know for me, where I am right now, it seems logical to be taking the money and putting it in after tax right now into a Roth IRA. Now, if I were to say make, in the coming years $200,000, it might change. I might take the taxes now because at the end of the day, dude, I don't think I'll be able to, make more than $90,000 a year income, after I get to 59 and a half. So it's just something to keep in mind and do calculations on your own. There's calculators on the internet as well. But I hope you guys really thought this was informative and useful for you guys. As always, appreciate you guys stopping by the channel. Feel free to like, subscribe the channel itself in the video, and leave any comments down below with anything I can help you guys with. I'm not an expert by any means, but I do like to talk about this stuff, and I do think of it as a hobby. So I appreciate you guys really giving me input and any topics of discussion that you guys like to talk about. Anyway, talk to you guys soon. Happy 4th of July. Forgot to mention that earlier on in the video. And hope to hear from you guys soon. Take care.